balcony.
Is that Monaco?
Yeah, that's my balcony. I'm not in Monaco.
Okay, right. Hi, everyone, and welcome to the Financial Fox, another episode of Smart Investing with Clem Chambers and Zach Meir. Hi, everyone.
Hello. The smart investing comes from Clem, though.
Yeah, why? Nice background, Clem.
Yeah, well, you know, I thought I'd sit on my veranda for a change.
Right, okay.
I need some better lighting to light the other side because I look like somebody sinister from a movie with the side lighting. Actually, I think I can organise that. Oh, you said reaching up. There we go. How about that?
Okay, right. So I wanted to start today bringing up, we are bringing up crypto and we are bringing up Visa decision to go all into NFTs and put a cyberpunk on the balance sheet. So what I'm thinking is Visa is kind of the best way to describe a middleman, right? Because the only way they make money is based on transferring information. I mean, crypto is kind of breaking down completely their system. So what's behind their ratio to go into cyberpunk? And is that going to be like an indication that we are at the end of this bull run? What's your take on that?
Who, me? Who, me?
Yeah, Clem, go on.
Okay, well, you know, I just think it's the big driver in lots of crypto is FOMO. Yeah. And first of all, people get FOMO, and then institutions get FOMO, governments get FOMO, the last people to the party. So, you know, they want to be cool and groovy, so they've got a cool and groovy crypto punk head. Okay, they can afford it. They can afford to be cool and groovy. You notice that the crypto punk head they picked isn't a fat old rich white guy. And, you know, it's all part of the gestalt, as they, I think they still call it. So, you know, NFTs, I mean, I'm reading lots of people saying, well, the boom and bubble is over, but it's going to come back, etc. And, you know, it's been the thing. It's been the thing. But I think in NFTs, you've seen a lot of what, if you did it in the stock market, you go to jail about, which is wash trading, where people are saying, oh, somebody, me, bought my NFT for 17 million. Oh, I'm the highest paid artist in the world. Oh, you bought it off yourself, didn't you? No, would I do such a thing? No. And there's a lot of that going on. Yeah. And it goes on a lot in crypto. You go on these exchanges and they have huge volume, but it's wash trading by the people that control that token. And that is a bit of a curse. And that's the sort of thing the regulators will stamp on at some point. But the NFTs, and then everybody passes and goes, oh, I want to sell my NFT. And of course, they sell nothing. Exactly. And they go, I wonder why these people are buying this for 27 billion trillion and I can't sell any of mine.
Well, yesterday,
it's not real.
Yesterday, the chairman of CoinShare put out a Ether Lambo for more than a real Lamborghini price. And I was like, that was, you know, it's kind of
himself.
So Clem, you hold Rarible. Are you still holding? Are you still waiting for the Coinbase?
Yeah, I'm still holding Rarible. I mean, one of the things that people do is try to guess the next Coinbase coin. The next listing on Coinbase, and today's one is COTI, C-O-T-I.
Okay.
So, you know, you try to guess them early on before anyone else knows it. And I think Rarible is one of those ones which has a high probability. Actually hit 38 last night. I mean, when I was talking about it, it was like, I think about 14 or something like that. And I guess that people were hoping it was going to get listed. And when it didn't get listed, it dumped back down to 32 again. But you know, Rarible is one of those ones that I think is a long-term hold. It's got a low market cap. It's got a dominant, well, not dominant, but it's got a big position in NFTs. It's one of the 2 or 3 brands out there. And it's the only one with a token. So it would be logical for people to list that one in the same way as Farm was a logical list at some point. And I'm kicking myself because I bought that at, I think, about $70 way back and sold it at like 300. and it was going down, and it's a great site. It was going down and down and down, and there's me going, oh, it's going to go to zero. I'll buy it then. They got hit for 42, and I was going, oh, that's almost cheap enough. Oh, $260 that is now. But anyway, but it got listed by Coinbase, and then bang, up it went, or rather, bang, up it went when the insiders knew, and then bang, up it went again when the rest of the world found out.
Can I ask a basic question? Because you've talked about, I think, the last couple of weeks, you talked about all these things as if everybody already knows them, and I'm sure a lot of people don't. What's the best trading platform for buying these tiddlers?
Well, they're not necessarily tiddlers. They're $300 or $400 million, which is, you could sort of call them a tiddler in terms of market cap, but not if you were in equities. But the way to get hold of them is a mixture of things. You can get them on some exchanges. So Coty, for example, was available on WhoBuy. I bought it on Binance. So Binance is really the big platform for crypto trading and tokens. And Coinbase,
is that the easiest one as well? I mean, is it easy to set up? And that's the other thing. Is it?
I think so.
I was on BitMEX about 4 years ago, just before in the year before that bubble, and it was like hell trying to open up an account and everything else. Actually, they've made
it's super easy, Binance. And by the way, I'm just going to jump in and say they allow the withdraw and the deposit. Just this morning, I got a nice email. You can still deposit and withdraw from you with your debit card. That's. But
yeah, so I mean, yeah.
Yeah, but I need the full KYC now. So.
Yeah,
so
but I mean, even a normal account is awful.
Yeah, they are very, very good, Binance, and they don't sponsor me, but they might. And
they should.
That's a very easy to join, full KYC, obviously, everywhere you go. Security's good. I mean, they are basically the £800. Them and Coinbase are the £800 gorillas in the field. And I use them. I mean, that's where I got my Coty this morning. That's one way to do it. Another way to do it is to go onto Uniswap and use a Uniswap or a SushiSwap if they're listed. But that's a little bit more complicated, a little bit more difficult, a little bit more scary, and a little bit more Wild West, because that's a site, a system that doesn't need any KYC. You do have to have a MetaMask or a wallet. You do have to understand how to use it. You probably have had some practice at it. It isn't cheap. It isn't fast. It isn't sure. It can be, oh, what, $150 to buy that? And Binance, it wouldn't be anything like that. But it is permissionless. And sometimes some of these tokens, you can't actually get them on Binance, and that's the only place to get them. So, I love Uniswap and SushiSwap. I know a lot of people that say it's too expensive. I don't like that, but I really like them. But Binance is really a very, very strong platform for this sort of thing.
Yeah, I kind of agree. I actually opened a Binance account earlier on last year, before I was just using Coinbase and Uniswap, because it's like you need to find the pair on Binance, and then using your debit or credit card, then you just buy the token there. But it works with the pair rather than Coinbase, for example. Is slightly different, I think, and the interface, it looks more complicated, like a Bloomberg terminal.
It is quite, I find it, I mean, it's like all these things. There aren't many places where, if you haven't used it before, it's easy. And you do have to get used to it. And Binance is like a proper trading platform. It's got its quirks and it's got its drop downs. And where's the search? Oh, it's all in black on black, shining black. And, an old fogey like me is going, where is the button? Oh, the font is rather small. And it, it's not a, it's not brain dead, but it's very powerful. They're very, very good. The security is strong. I've used them. I don't use them a lot, to be honest with you. I'm an anarchist at heart. I like to use the permissionless stuff, like Uniswap, like SushiSwap. That's where I like to live. But Binance, it's very, 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 very good. And Coinbase, very, 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 very good. And Coinbase, they don't pay me to say that, but they could.
Clem, and also you can short on Binance. Do you short? Are you a shorter? Are you a shorter?
I'm not a shorter. I'm not even a shorter on equities. I'm a great long player. Short player, hate it. I mean, let me tell you a story, right? I used to spread bet quite a bit, and I made a reasonable decent amount of money at it, but only about a third of what I'd make in normal equities, because of the way that spread betting works. It actually, interferes with my trading psychology. And if I've got a stupid bet where I might make £5 or £10, I'll be waking up at 4 a.m. to see whether I made £7. Whereas if I've got a gigantic position with lots and lots of decimal points, or only one decimal point, but lots of zeros, I don't care. And therefore, I don't wake up at 4 a.m. to check whether, my Rio has gone up or down in Asia or anything like that. And so in the end, I thought, this is ridiculous to have, it's too much fun. It's too engaging. You don't need to be that engaged if you want to do it properly. You need to keep your emotional levels low. So shorting is another one of those things that you start shorting, you start going, oh, has it gone down? Has it gone down? Ah. And it's too engaging. And on top of that, I know it's mathematically not correct in terms of trading symmetry, but you can lose 10 times your money if you go short on something. You can only lose 100% of your money if it goes down. And I do prefer not to buy Bitcoin at 300, or rather go short of Bitcoin at 8,000 and end up with it at 60. So, and I know mine shares that I buy at whatever, £1, and they go to zero. I don't care. It happens occasionally. I don't care. I let them go, goodbye. And I've lost whatever I put in. I don't care. Yeah. But, the prospect of buying I can't even say going short Rarible at 14, and it hit 38 last night. I mean, oh no, I don't need that.
Exactly. Zach, are you a shorter?
I think that's, well, actually, I think Clem just talked me out of it. I think I think the problem is that there are very few times when you see a situation and you can just say, right, that's it. I didn't like Boohoo, for instance. So that's it. It's to sell there at £3, it'll go back to 250 or something like that. But I think Clem is right in the sense that, with shorting, even if you get it really right, you don't, you make a sort of a third of what you would do with going long in a way. And obviously you've got the downside there that if you are wrong, and Boohoo's a great company, then it's curtains. And I do think it is also against the natural mindset that people have. And in fact, if you look on Twitter and if you look in other places of people who are shorters, they always have a sort of a very evil, nasty, scheming, suspicious mindset, which I think you have to have in order to be a successful shorter. And I'm sure Clem doesn't fit with Clem's personality, doesn't fit with my one either. And I think, for instance, a lot of the small caps that I'm sort of looking at, the people talk about, a lot of the time when the shorter says it's fraud or they say it's a lie, it's actually just the management not knowing what they're doing. It's not actually fraud. They don't actually. They said we'll make £1 million next year, and they make 50 quid. Well, it's just because they don't actually know what they're doing. It wasn't a lie, and they're so incompetent that it wasn't fraud either. I mean, they probably just don't understand what they're doing. And so, in order to be a successful shorter, you have to be saying, that you have to be looking at people in a very strange and probing way. And I think that when you get it wrong, there's a couple of stocks which are sort of famous for people getting them wrong on the short side, Eurasia, and I think Novocyte was another one. Novocyte was another one last year. But last year, the pandemic really it was a real shorting surprise, because with the pandemic, a lot of people went short thinking that's it, it's all over, it's the end of humanity, FTSE 5,000, etc., etc. And I think it's not a way to go. The way that most the people who are in the market probably had their best year ever from March last year to March this year, or April last year to March this year. And you only need a period like that to be set up as a good trader. Same with probably the same with the crypto area, the Bitcoin thing. Okay, 60,000 it became a bit rich, but I think it's always been better to look at Bitcoin the right way around rather than the wrong way around, thinking it's just going to be one day it's going to be closed down and this and that. I think it's just the risk reward in that is just not good.
Well, I was very bearish at 60,000. I was in fact very bearish from sort of like 40,000. But I didn't short it, thank goodness.
Yeah.
Yeah,
So
and you're looking. I mean, I think it wasn't in. I wasn't trading. I wasn't trading it at the time, but I think it was you sort of had when it was around 30,000 and it's sort of fallen 50% off the top. That was psychologically and otherwise. You sort of think, well, if I buy at 30,000 or something like that, even if it goes totally, horribly wrong, I don't feel stupid, and it's probably going to go up from there. And that's sort of what's happened, So,
Well, I
but
mean,
if you had, but you could have had the mindset that it's 60,000, it's going back to 2,000, it's all over, and that would have been rather nasty, I think.
another way I like to look at it. Well, there's this company, okay? It's a car company, and it's probably not very funded, and it's got some young wild person running there. And if you look at the big car companies, they're worth 50 or 60 billion, and this crazy little car company is worth 30 billion already. I mean, it's worth half of Ford. It's worth half of General Motors. And it makes hardly any cars at all. And these guys, they make millions of cars. Yeah. And it's already got half the market cap of Ford. Well, let's wind it forward a bit. This crazy little company has already got the market cap of the whole of Ford. I mean, what could be clearer than short that one? I mean, it's a maker of sports cars and crazy, unproven technology.
Yeah, but the problem with that is it probably won't be a short. That's the problem. It might go down 10%.
If Tesla, it goes to $1,200.
Yeah, exactly.
It goes one of the biggest companies in the world. So all the logic in the world about Tesla, coming out with their car, which is ridiculous that it should be worth even as much as General Motors, it's now worth 20 times what General Motors is worth. I mean, not quite 20 times, but 10 times. And there's as far as I'm concerned, there's no logic to that at all. Even now, there's no logic to that. Even if they was big car manufacturer as General Motors, it's like it doesn't make any sense. It does not compute. You're absolutely lost your shirt.
But that goes back to what you said though, that if you went short, I mean, I think I know of people who've gone. I know I've got people who've gone short of Tesla. I mean, there is, it's been life-changingly bad. And but it comes back to your thing that when if I go long with Tesla at the top, I probably lose half my. Exactly. That's the thing, that you can always make 10 times your money going long. You can only and you can only lose what you put in. Whereas shorting, you can go on forever. I mean, it's just infinite.
Well, that was my point. I was telling a story of what is an obvious short. If you've done it, you'd have your face ripped off. I mean, there's on the long side, there's so many companies that make no sense with incredible valuations.
Okay, shall we, Clem, tell us a bit more about this company where they are looking so overvalued that, you will never look at.
You can't, well, I mean, there's just so many of them in the market at the moment. There's just so many of them. And there always is loads of companies, the darlings, they don't make any sense. And they're up there and they fly high, and you say they can't stay up there, and they fly higher. And you think that's ridiculous, they fly higher. I mean, have a look at something like, okay, let me give you another error. Okay, Apple at 500 billion market cap. Well, why would you hold that? Is it going to double to $1 trillion? No company's ever got to $1 trillion. And now it's 1.5 trillion or something like that. I mean, if you take 1.5 trillion and you divide that by the population of the world, you get to half the price of an iPhone in itself. So it doesn't make any sense. But with Jay Powell cranking the handle, printing money, things do not make sense anymore, because the market, for example, in that field is cornered. It's a cornered market. Interest rates.
Well, no, but I think that's the point with all these tech companies, and it's even the value of ADVFN. You know the story in the .com sort of that generation, the companies which had the first mover advantage could not and cannot be dislodged. They're always going to be, the Facebooks with the Googles, all those companies. First, the people who created that railroad.
I don't disagree. I mean, I totally agree. But if you look at the way that markets are valued as a whole, and you look at 80% or 90% of how the market is valued as a whole, those companies, they don't obey those rules. And we know why they don't obey those rules, because they are liquidity and reserves for money. and they're as some people call them, hedge fund hotels. Yeah, but they're not just hedge fund hotels; they're liquidity hotels. Interest rates at 0% does not make any sense. Yeah, as we all find out when we try to buy stuff on a credit card and we get charged 19%. But that is the way the market is at the moment. In the old world, nothing in this situation makes a great deal of sense, and that is probably the danger for most investors, that it's got disconnected because of COVID in particular from the old economics. And if those economics ever start to reset back to anything like that, then there'll be hell to pay. But maybe it won't. I don't think it will, because I think that the normalization will come through a strong burst of inflation over a period of 5 to 10 years.
Clem and Zach, I want you to tell me what you think about a sector that was very popular maybe 5-10 years ago. It was the hottest place where all the private investors go, which is oil and gas. Now, oil and gas is, it's got pest, pandemic, malaria, whatever, COVID. No, it looks like it's struggling. Do you think it's like a transitional period because we are all in love with the sustainability and renewable energy, or there are still opportunity for the sector to show some sparkling?
Well, shall I take that first? Or,
yeah.
Yeah, no, I think that oil and gas, probably the simplest explanation is the sort of woke tree hug of ESG stuff going on. So a lot of people now just say, I don't want to be involved in oil and gas. So that takes out a lot of the potential investors. And that in itself would have been a body blow. Clearly the pandemic, and I think there's going to be a change of behavior with the pandemic. It already has been. But if you look around, you see that, let's say probably more people are buying secondhand cars and driving around and not going on the train, which is getting more expensive by the day. So I think it's a bit mixed. I think probably that the ESG argument is actually the biggest wounding factor for oil and gas rather than anything else. But gas, obviously, we're still very dependent on. And so it's one of those things where you've got to sort of say, well, is the sentiment an opportunity to buy value, or is it just a sort of fashion that we don't like fossil fuels, or is this something that's going to be there for still quite a long time? And I think it's probably the latter rather than the former, and probably use the dip or the value that may be there in producing oil and gas companies and go for that. So I think it's a bit of a fashion trend rather than anything else.
Okay, interesting. Clem?
Well, I do think the industries themselves, in terms of investments, are blighted by the environmental climate change theme. And personally, I think it all backs out to the price of things. So if you say, oh, well, I bought an electric car and therefore it's good for the environment.
Clem?
Well, I do think we've got funny feedback now. So if you get, you just have to look at the price to see the carbon footprint. And the more expensive it is, the bigger the carbon footprint. And I think, that's because the way commodities work, because all commodities are fungible. And therefore, whether you like it or not, depends on how much money you're spending, on how much CO2 you're releasing. However, that's not how people see it. That they just want to have easy concepts to grasp onto. And oil and gas, oil companies are evil, has been a theme for ever since I was little. See a movie about the oil industry, it's about evil men doing evil things. So they've got a problem, not just with decarbonisation, but just with, I wouldn't use the word fashion, because I think it's deeper than that. It's just the cyclical change in the way that people look at energy. Give it 10 years, nuclear power might actually be in fashion, and people might say, roll on nuclear power. And when you think, when I was young, nuclear power was the most evil concept on the planet's surface, and everybody hated nuclear with a vengeance. So it is down to the way that new media is shaping opinion and policy and action. And I don't think all of a sudden oil is going to get fashionable or coal's going to get fashionable. They're still going to be burning it by the truckload in Asia, even if we never used another drop of it. They're still going to be, pumping it out, more coal produced in China, et cetera, et cetera, et cetera. So the economic realities of energy are very real, which probably means that you'll be buying an asset with a low market cap in comparison with the amount of business it's doing, paying a gigantic dividend, which is, not a bad thing.
Yeah, I think the point that people have to realize as well is like the oil and gas is still very important for the transition to a renewable energy. And so that's, as you said, has to be used. So, they're demonizing something that, is going to be here to stay and is actually quite important for energy security for many countries, even the UK. But
even outside, I mean, I look at it this way. If you take something and you destroy it, and that its purpose is you get it and you destroy it, then it's actually way too cheap. Yeah, I mean, it's like mackerel. I mean, mackerel are caught and killed to turn into manure. We know what manure is, and a less polite word. So it's so cheap and so plentiful in the sea that they can afford to pull it out of the sea, kill it, and let it rot, and throw it on fields. Yeah, well, that says to me it's too cheap. And when you think they're killing animals just so they can rot them and throw them on a field, that's kind of awful just the thought of that. But oil is the same. They dig this material up, not to process it, not to turn it into chemicals or plastics or medicines or dyes or all the other wonderful things that oil makes, but to just put a match to it. So in my mind, I go, it's probably too cheap anyway.
Zach, you're overviewing all the small cap madness and upside and all the exciting stuff. Which are the companies that you come across you think they are pretty undervalued? So we go on the other side. Any like gems that you kind of like, so we can extrapolate them for investors too.
I think I was discussing this there's a company today called Helium One, which had a sort of like a sort of slightly awkward update, let's put it that way. And helium is supposed to be one of the, that's the technology. Sorry?
Chip making.
Yeah, that sort of stuff. So it's a really, really good asset. And this company has looks like he said it's like this. Well, I said it's like the Saudi Arabia of helium in Tanzania. So that asset there, and that company is now briefly this morning it was the same price as it was at the IPO in December, I think it was. And after having this went down to 4p, having been 28. And I think there is in the small cap world that you have the problem where because you've got so many retail people in there. And most of them just like getting, they're probably sold today so that they can have some money for the bank holiday or whatever. You have all the slings and arrows like that. I think that's a company which has been treated unfairly and it's got cash in the bank, et cetera, et cetera. But the RNS, maybe it's a bit clumsy or it wasn't clear and the share price suffers. So I think there are situations where when companies don't communicate properly, then you can have that. There are other companies where, for instance, cybersecurity. There's a company called Brand Shield, and I think it's quite a unique type of cybersecurity because it's not sort of an in-house threat. Within the company server, it doesn't look at stuff on the company server and sort of check for threats there. It looks outside the moat of your activity. So if somebody's doing a phishing thing in your name or cloning you or whatever it is. Somewhere in the world, they will track that down. So there are companies which I think are doing things which the market doesn't understand, either because they haven't explained it very well or because it's an area which is not described or not thought of as being revenue generating. So those two are the ones that come to mind, the Helium one, which I think is fantastic, and that sort of new type of cybersecurity, which is external cybersecurity, which I think is quite cool. But a lot of these things, they're sentiment driven, and it's almost the skill of the CEO to communicate properly. And some people, they come to market and they're loved and adored, and some are not. And I think, I would say probably what Clem has done over the years has not been fully appreciated. And, you know, that's for one reason or the other. And, you know, but the market, you know, the market likes a certain type of CEO or a certain type of person, or, you know, that's the thing. And in the small cap area, it's very much a bit of a roll of the dice, how you're looked upon. So, and you don't really know until you get there. So those two companies are my selection at the moment. But I think, you know, there's probably quite a few. I was thinking of writing an article on bargain basement stocks, but maybe I'll do that in the next few weeks, because I think that maybe when people come back next week, then there'll be a bit more liquidity in the market. I hope there will be anyway.
So are we kind of still that people like sell for the bank holiday?
I think there was that. I think there was a bit of.
I mean,
no, because it was just like, oh, well, I need a couple of grand to go to Bournemouth. I'll, you know, sell some stock. I mean, we're not, you know, this is not George Soros stuff. You know, there are a lot of people in the market like that, and you know, that's fair enough. But it's I think you could see that a bit in July actually with the Freedom Day. There was a sell-off in the market that Monday. It was almost as if, you know, people were selling their stocks so they could go out and play, you know. So yeah, obviously we had the good side of that. We had the good side of that in March, April last year, when people just got bored sitting at home and started punting on stocks, and a good time was had by all.
Clem, do you think like with ADVFN, are you kind of seeing the kind of activity that the kind of people, maybe retail slow down during Christmas?
And it definitely slows down. Yeah. I mean, you know, July and August is definitely a traffic slowdown. It is seasonal, and you know, yeah, no one's watching the market when it's closed. Well, now you can, because there's crypto, but which is great news for us, because crypto is a whole new marketplace and a whole new generation of people, and you know, that's tremendous news for us. So yeah, it's not, you know, obviously you get a big peak at 8 o'clock, and then it goes off, and then it comes up for lunch, and then it goes down, and then the UK market shuts, and there's a whole curve for the whole day for trading. And yeah, I mean, there are peaks and troughs during the day, peaks and troughs during the week, peaks and troughs during the year. So yeah, definitely it is seasonal. Now I don't, you know, when you look at the market, there's lots of different sections of it. You know, there's the well-off, boring old people like me, and then there's, you know, young engineers, and then there are the people that are just gambling, and they're, you know, punting £1 a point on something on IG. You know, it's all over the map. So you go from investors to gamblers, and you go from people with not a clue up to people that are, you know, been professionals for 40 years or 50 years. So you get the whole gamut, because, you know, we're like the BBC of stocks and shares. Everybody watches us.
Yeah, that's interesting.
I was thinking about this. I was thinking about, you know, sleepless nights thinking about this particular broadcast. And earlier in the week, I revisited somebody who I've known for 20 years, or yeah, basically 20 years now, Tom Hugard, who used to be at City Index as a broker there, and then he's become a sort of online trader, right? And I was just looking at he's actually got quite good over the last couple of years. So I was looking at his presentation. Obviously, I don't look at anyone, because, you know, that would be like a defeat. You know, I'm supposed to be the king of the castle. But actually, I did look at his stuff, and a lot of really interesting trader things. You know, like if Friday doesn't break Thursday's high, then it's, you know, you sell on the open on Monday. And he's sort of done, you know, and sort of like the Dow's gone up from, you know, 3,000 to 35,000 in 30 years. What's the ratio of winning days to losing days over that period? And you'd never guess that it's actually 50-50. It's unbelievable. So just things like that, it's jaw dropping that you never believe that, you know, it's up by that amount. But the actual day to day is just literally a toss of a coin, and things like that.
Hypothesis tell you that, Sam. You should read the efficient market hypothesis one day. The efficient market hypothesis says exactly that.
Yeah, no, I mean, but it was something that, you know, it's counterintuitive, so it's fun like that. The other thing, which is, you know, he was sort of saying, you know, you want to be like the 1%. Well, everybody was like the 1% everywhere, but the 1% in the market. And I suppose that's another thing about, you know, everything comes down to the 1%. whether it's the Silicon Valley billionaires or anybody else or IQ. And he said in order to make money, because obviously you're going to be part of the 90% that lose or 95% that lose, you've got to do something differently to what most people do. Exactly. Most people, when they trade, they cut their profits and they run their losses. Yeah. Obviously. And they take small profits and they take big losses.
Efficient market hypothesis says that doesn't make any difference.
Yeah, and then also they'll tend to try and buy at the bottom and sell at the top, and that comes back to the turtle trading thing, which I'm sure you've heard as well, Clem. That was a successful, allegedly successful way of going. So you were training people to momentum trade basically, and then finally it was just a sort of point that he pointed out that even if you put tomorrow's share prices and commodities prices and crypto prices on the front page of the FT today, most people would still be losing. Almost the same amount of people still lose money. They just can't. They're hardwired to lose money. They can't break out of that. Taking a profit too early and not adding to a successful position. And my question after all that is do you think that it's nature or nurture? You are somebody you're sort of saying, oh, I'm going to buy this, I'm going to buy that. Is that your talent? And that's it. It's a talent you have. There's nothing you can do to lose it or make it better. It's a talent you have. And if you don't have that talent, is there any point being in the market?
Well, I mean, the first thing is it's a skill game. So you've got to have the best tools. We provide that. We provide the tools, for example, that I need. That helps me a lot. The second thing is you better skill up on all the technicalities. You see, the thing that stuns me is that, see, somebody like Zach, who's a brilliant investor and trader, has no fucking clue about efficient market hypothesis, which is absolutely the bedrock of the whole industry. He does well because he's a natural talent. But you, for example, there's no such thing. If you run your profits and cut your losses, it's no better than running your losses and cutting your profits. It makes no difference at all. Under an efficient market hypothesis, people lose because they win half the time, they lose half the time, and minus the cost of trading. It's the cost of trading that kills them over time. Now, if they do gambler's ruin, which is they overposition their size, again, something you can refer back to the efficient market hypothesis, correct position sizing, they'll still lose all the money, but it just takes them a long time. If they don't get the position size right, they get killed really quickly because they get a gambler's ruin, which is a stochastic process. People don't study probabilities and stochasticness. And if you don't do that, you're already at the bottom of a very big hill that you have to climb to win. You have to know ins and outs of everybody and CEOs and all this, that, and the other. Because most people, not even most, hardly anybody studies the basics. Yeah. And people say, oh, efficient market hypothesis, it's rubbish. Well, go to the options market and start trading that and get killed by all those people that trade on the basis of it, all the professionals that run stochastic models to sell you the options that are going to kill you. Yeah. And I don't know anybody that studies or trades under the basis of efficient market hypothesis, apart from the professionals in banks. Yeah. Funny enough, they win. Funny enough, everybody else loses. Yeah. But you can buy a book. You can buy a Random Walk Down Wall Street, which is the basis of the whole ETF market. And you put that in a professional's hand in the city and they go, oh, it's rubbish that. Oh, no, don't believe it's not a random walk. Oh, no. It's cool. What a load of rubbish that is. No, of course it's not a random walk. And yet it drives all the ETF, which has been the long-term, most benign thing ever happened to the stock market in the last 40 years. It drives a whole option market, which, boy, you will lose your shirt faster than say knife if you go, trading your gut there. And we all know what our guts are connected to, so it's not that surprising. But efficient market hypothesis, if you don't study that, you are going to make a mountain of difficulties on yourself. Now, I have, and therefore it makes it easy for them, or much easier for me than all those poor people that don't realize all this. If you do this and that, and you do that and the other. I've studied what happens on the Thursday night on a Friday morning. It's all 50-50, funnily enough, because it's random. And I've actually put algos on the random noise, stripped out the signal, and it's tiny. It's called a skew. All that 50-50 everyday winners and losers all that rise is called a skew. It's all there in the literature. People won Nobel Prizes, you know, cracking this code, and nobody gets the book and reads it, or even the Idiot's Guide to it. And
so
they
that
wonder
comes
why they
back to
don't
having
make
it. So the efficient market hypothesis is the equivalent of having tomorrow's share prices on the front page of the FT today. In that way,
it's the equivalent of understanding why you're losing money, and it's the equivalent of understanding when people are selling you a bill of goods at training course that it's not true. And it's equivalent to not making all those mistakes. Like, why did you buy that stock? Oh, I don't know. Somebody told me. If I buy Helium-1 now, because Zach has said, I just behave randomly. Well, not randomly, so I rate Zach's opinion. But it's pretty close to random. Yeah? And if there's 100 trades in the next 10 minutes, 98 of them will be random. And of course, you'll make a bit, you'll lose a bit. Well, actually, now the skew is the Fed pumping money into the system. So everybody's going, buy, I made money, I'm so smart. Buy, oh, I made more money because I'm so smart. And there's Jay Powell doing that in the printing press, printing the money out. And when it stops, they lose it all. They go, oh, I lost all my money. And they won't know. They won't know that the reason why they're behaving randomly was paying out was someone was pumping money into a pipe. But if they understood the random walk, they'd realize, well, why am I making money here? What non-random thing am I doing? Well, what non-random thing you're doing is you're coattailing Jay Powell printing money. Bang! That is tomorrow's share price on the front of the FT, isn't it?
all right. I'm sorry I asked now, but the question I was trying to ask is this nature or nurture? And you're saying that it's definitely nurture because you have to do the legwork, you have to do the study. And so Roger Federer looks like, he's the best tennis player in the world. That's not Nate. It's nurture that's grown that talent, or how would you describe it?
Well, there's that book by the New York writer with the frizzy hair, and it's all about you've got to do 10,000 hours to be great, and that's the only thing. 10,000 hours, and he's another 50-50 guy. When he says something, it's half right and half wrong. But you can't beat
Gladwell.
Malcolm Gladwell. Yeah, very, very amusing. And you cannot beat talent. And there are naturally talented people. You see them. They are naturally talented. And they'll pick up a guitar and they'll play it, and they're naturally talented. But they'll never be the concert guitar player unless they practice the 10,000 hours too. So if you've got natural talent plus you do a lot of it, you will be Roger Federer for sure. I mean, you see tennis players; they seem to have an extra vertebrae in their back somewhere, and they have that natural talent. But boy, do they have to practice to get to Wimbledon. If you do both,
no, I think I mean, I've probably done 100,000 hours, but on just let's say on the charting front or something like that, right? And I think what's interesting, I think if you're on the right track, which I'm hoping I am, is that as time goes by, you actually gain momentum in terms of getting, you sort of improve. I'm not saying exponentially, but you improve increasingly if you keep going. So from 1990 to 2000, I might have improved 5%. In the next 10 years, 10%. But in the last 3 years, especially with the pandemic and Bitcoin and all these things, probably 30%. So that's sort of something which, if you're on the right track and you're just putting in the time and the effort, I think that does happen. And I'm always trying to improve either on the fundamental analysis, reading RNSs, or on the charting front, because I've seen, 1,000 or 10,000 before. And although I understand what you're saying, the random walk, and you could have the same chart now in a stock as, Helium-1's chart now looks exactly the same as Quindell's chart that was 10 years ago, but something totally different thing will happen tomorrow. That's what you're saying. That's the other problem, isn't it?
I'm saying that you are not investing or trading at random. Yeah. For example, you spoke to the guy at Helium-1. Maybe he has a funny voice, being from Helium-1. But anyway, you spoke to him. How many investors?
Well, he wasn't, because he hasn't found that he hasn't got the helium yet, so that's why he was still speaking in a normal voice. But it would be better if he should have done that.
So that is non-random behavior, and non-random behavior will make you money. Yeah, and random behavior won't lose you money but the cost of the random behavior will. It's your brokerage that will bleed you to death. Yeah, or your data subscription, or whatever it is that's costing you to do that random trading, win one, lose one, win one, lose one, win a lot, lose a lot, win a bit, lose a bit. You know, that doesn't cost you anything, but your commission does, your stamp duty does, all the other things cost you money. And that's why you bleed to death. But you and I do not all the time anyway, trade randomly. And therefore that's why we win. Most people are 100% random traders, and that's why they lose. And you know, that is one of those aspects that you can focus on. You can focus on them all if you really want to. But if you focused on knowing a company inside out, you will do well, because that's non-random behavior. If you focus on studying charts to the max, you will do well, because you will find things that will work for you. If you study the balance sheets, that's all you do, you will do well. If you study
so it is a bit doing something. I mean, Tom Hugo has been slightly smashed in this, but it is a little bit of doing something differently. And you can't tell me what you do differently, and I can't tell you what I'm doing differently. We're going to lose. So my different things are I interview 5 CEOs a week, and I know let's say 100 CEOs. And so I can call them up and say, well, what's this? And I can tell by the tone of their voice whether they're happy, they're sad, et cetera, et cetera. I can look at the chart. I know that like if the shares of that company have gone down to where they were when at the IPO, then obviously most people have got out now. I mean, maybe more people get out, but I mean, there's, I can't believe there's anybody left to sell. I mean, that's another factor with that one. I mean, just complete car.
They don't burn the certificates,
Yeah, exactly. So there is like that. So I mean, that's the sort of optimistic thing, that I'm doing something different, and therefore I've got an edge over other people, or a combination of things.
It's all about the edge, and what that edge is good that you know what it is. But most people are not trading with any edge at all.
No, and they are mainly kind of driven by rumors, by what their mate is doing, what is hot. I think most of the investors, they are just jumping on the bandwagon of something or in a company because they've been told, rather than believing it or having done any research or knowing about the market as well, which is another.
It's entertainment.
Yeah.
People don't go and put back horses, or even race horses, or even own horses to pull carts anymore, or ride to the shops. Yeah, it's entertaining. They enjoy it. It's a activity that gives them pleasure. And a lot of people who trade or invest, it gives them pleasure, which is why a lot of people don't do it. Which is why a lot of people just hand it over to a fund manager, says, take the money, do that. I'm not interested. And that's a large group of people just not interested in it. A lot of people, it gives them. I always say, if the market pays you in anything but money, your financial returns will be lower, because the market pays you in the coin that you wish to be paid in. And if it's in entertainment, it'll pay you in entertainment. It won't pay you in cash. If it's just the pure satisfaction of owning shares, you'll get paid in that. I need to own a flashy share. It'll pay you in that. It won't pay you in money. If you want to get paid in money, and that's all you care about, you'll get paid in money, because the market pays you to take risk, and it will pay you in whatever coin you want to be paid in. And most people, that's entertainment.
Yeah. Next time, Clem, I want you to talk more about the tools that you use, the one on ADVFN that are helping you to make a decision.
You can with my tool.
Exactly. I think that would be a very, very interesting.
Yeah, I think the thing is, it's one of those things that it's all very well people who been around the block talking about stuff, but I think you forget how long the journey is and all the building blocks you need to get to that stage. And I don't where do I look? What's the best place to go? I asked you about Binance, and that's a good answer. But I think that a lot of the reason that people never get the edge, because they don't actually know where they should be looking or where to look and how to look at it.
But I think, Zach, it's also about making mistake. And I'm going to tell you what's happened to me just a week ago. I actually spotted a coin that went up loads. And I just put like £200, and he basically, I made $3,000. Okay. And then I said, more than $3,000. And I said, okay, great. I just bought the right one. And I'm gonna sell it and then get the money in. But because I was such in a rush, I did move from Binance Smart Chain to Ethereum Smart Chain, and I send it to my Coinbase wallet from Binance Smart Chain to Coinbase, and the fund, they got lost. So they got lost. They disappear because there is no support between the two chains, which I know I shouldn't know, but because you don't pay so much attention as you should, and you don't. Now I won't make this mistake anymore. Definitely, because it costs me some money, but it can cost you even more money if you are dealing with higher amounts.
It's so easy to click that button. I don't know anybody apart from me, and I've been lucky, that hasn't blown a big chunk of money by sending a coin to the wrong chain and it's gone. And I mean, I remember, and it was a serious amount of money. I think it was like 80 grand.
Yeah.
And I went click, and I thought, oh no, I've done it wrong. Oh, I sent it to the wrong address, which means it's gone forever. Oh, thank God I haven't. But if for a minute there, my dinner went from chest high to my waist.
Yeah.
And
it's horrible.
It's a great weakness in crypto that sort of thing can happen.
Yeah.
But
and then you can contact Coinbase and say help me, whatever, but they don't, because it's written there. It's not supporting. It's your responsibility. Whatever you think, well, I could have gone on holiday or could have done something with that money. They actually, for one time, you just spot the right one. And
a nice bottle of wine.
Exactly. But I think that, so coming back to investor, I think also is making mistake and learn from me. And I think many investors actually don't take this learning process seriously. They just keep doing the same mistake.
Well, maybe next time Clem can walk us around the ADBFN site, or have some screenshots. That might be useful.
I'd be happy to show you a very, very simple way to select really, really good stocks that in the long term will do very well.
Okay, let's do that. Okay, thank you so much for for your time for today. It was very good.
And thank you, Zach, for letting me use you as a punch bag.
Always a pleasure. That's the sort of person I am.
Thank you for everyone who